So we're going to get going and we're going to start. We're going to cover MAC 4861 Test 1 2018. Before we get into the actual question, just a quick high-level overview of the weighted average cost of capital. Remember, the purpose of WACC is basically to determine an overall cost of finance to the company. It is the discount rate that is used to evaluate various things. One of it is used to evaluate long-term investment projects, to evaluate so it's used to evaluate long-term investment projects. It's used in valuations. It is used in financial reporting. So the weighted average cost of capital is an important number. It is used quite extensively. By now, you should be able to have a picture in your head of how to calculate the weighted average cost of capital. So how do we actually go about calculating the weighted average cost of capital? Remember, the first thing you want to do is to focus and is to write down the formula. So the formula says WACC equals the cost of equity multiplied by its weighting plus the cost of debt after tax multiplied by its weighting. So that's important to understand. The next step you want to do is to set up your table. The first column of your table is your components of capital or your sources of finance. The second column, the second, third, and fourth column, there's no particular order, but the way I go about doing it, my second column would be the market rate after tax. The third column would be my market values, and the fourth column would be the weighting. And then finally, the fifth column is my weighted average cost of capital. Take note that there's three things that you want from WACC. The first is to identify your sources of finance or your components of capital. Then you want to determine your market rate, and then you want to determine your weighting. Now that weighting is basically your target capital structure. What is your target capital structure? Your target capital structure is your long-term sources of finance. And more specifically, it is your debt and equity. Which debt? All long-term interest-bearing debt, and which equity? All forms of equity. Now, in some cases, they will give you the target capital structure. And if they do, you use that ratio that is given, that percentages that is given. But in most cases, the target capital structure is not given, and you have to calculate the target capital structure. So the way we calculate the target capital structure is to assume that the target capital structure is our current capital structure, but the only difference is we base our current capital structure on market values. And that is why we have that market value column. If the target capital structure is given, then we won't need that market value column. So just be aware of that. So that's the three things that we need to determine WACC. Source of finance, your market rate after tax, and then your weighting. Like we said, how we get to the weighting is either the weighting is given or we calculate it by using the current capital structure based on market values. So that's important. Just see that big picture. What are we trying to get? What are we trying to calculate? We're trying to calculate the general cost of finance for the company. So that's important. We're trying to calculate the general cost of finance for the company as a whole. Okay, so that is the purpose of the weighted average cost of capital. Now the next step is now the detail. So once we go into the various components of capital, typical examples, ordinary share capital, preference share capital, debentures, long-term loans, bonds, and so forth, those are the typical sources of finance. We want to be able to work out the market rate for each of those and the market value for each of those. So let's start off with preference shares and debt. Preference shares and debt is calculated in the exact same way. Okay, so basically when it comes to preference shares and debt, the first thing you want to do is to identify what was given, the market value or the market rate. Depending on which one was given, you calculate the other one. So if the market rate was given, you will calculate the market value and so on. Now, once you get into the calculation, the first thing you ask yourself is this instrument redeemable or non-redeemable? If it is redeemable, that means there's a specified date of repayment. Then we either use the financial calculator, those 5 buttons, or we use a cash flow table. If it is a non-redeemable instrument, that means there is no specified date of repayment. We use the perpetuity formula. Now, you need to sit and think what I'm saying, and you need to write down when you're going through WAC. And you need to tell yourself, okay, if it's redeemable, then we're going to use the financial calculator. You need to know what does each variable on the financial calculator represent. What does PV represent? How do you get it? What does future value represent and how do you get it? I mean, sorry, what does FV represent and how do you get it? What does PMT represent and how do you calculate it? What does N represent and how do you calculate it? What does I represent and how do you calculate it? So you need to go through those type of things so that before you attempt a question, you'll already have those stuff running through your mind. And that's how you're going to become easier. If you're not going to take the learnings from each question, then every time you start a new question, you're going to be on ground zero. The whole purpose is you're on ground zero. So after question one, you want to be on ground one. Once you are on ground one, once you attempt question two, you're now on ground one. You're not on ground zero anymore. So then when you attempt question two, you want to be on ground two, and so forth and so forth. So each time you must be improving. One of the biggest dangers is when we run through multiple questions quickly, we're always starting on the ground floor and we're not taking our learnings from the previous question into the next question. It's important to make sure each time you start your new question that you take the learnings from the previous question so that you implement what you learned and you avoid the mistakes that you have made in the previous question so you can just become better and better. So just be aware of that. Now, when we come to ordinary share capital, with ordinary share capital, we also want to calculate the market value and the market rate. You must tell yourself before the time. So if you know you're going to attempt WAC, you must already run yourself through the summary of WAC and tell yourself, okay, when I come to ordinary share capital and I want to calculate the market rate, I have 3 options to calculate the market rate. What are those 3 options? Option number one, in no particular order. Option number one, the capital asset pricing model. Option number two, the dividend growth model. Option number three, the bond yield plus risk premium. Now you have made mention of those 3 formulae. The next step is to say, okay, capital asset pricing model is calculated as follows. Cost of equity equals the risk-free rate plus beta multiplied by the market rate minus the risk-free rate. So now you're telling yourself what the formula is. So now if you look at the formula carefully, there's basically 3 variables. Number one, it is the risk-free rate. Number two, it is beta. And number three, it is the market rate. Now, typical examples of the risk-free rate is your long-term government bond. You generally take the longest one, so they give you a 10-year or 15-year, you take the longest one, which is 15 years. Because ordinary share capital is there basically for a lifetime, so you always choose the longer period. So a typical example of the risk-free rate is a long-term government bond. So they'll say the R108, the R202 government bond, so you take one of those. They're not always going to say this is the risk-free rate. Then beta will be given, and then market rate. What is the market rate? So they can either tell you this is the market rate, or they will tell you the average return on the JSE is so and so, and then that is indirectly telling you that is the market rate. So so that is what the levels you want to go to. So to just to recap, we're saying if we think about the market rate for ordinary share capital, tell yourself that there's three ways to calculate the market rate. What are the three ways? CAPM, dividend growth model, bond yield plus risk premium. So how do I calculate CAPM? How do I calculate cost of equity using CAPM? We gave you the formula. And then we also identified what are the variables and we gave examples of the variables. That's the level you want to go to. The next one is the dividend growth model. The dividend growth model is calculated as follows. Cost of equity equals D1, which is the dividends of the next period, divided by the price today, the share price today, plus the growth rate. So that is the formula for the dividend growth model. So once again, there are three variables. Dividends, but not any dividends, the dividends of the next period. The share price, the current share price, and then number three, the growth rate. So now we know we are looking for those things. The share price will most likely be given somehow or another. You might just take note when you're dealing with, because there's a common error, when you're dealing with a dividend growth model and you want to work out the market rate, you can either work it on a per share level basis or on a total basis. You just need to make sure that both the dividends and the share price is both per share or both on total. So just be aware of that. So the share price will most likely or generally be given to you somewhere. Take note, they're not always going to give it to you with all the information that is linked to ordinary share capital. They will most likely give it to you right on top when they discuss the background of the company. So just be aware of that. The second thing that you want to the second thing that you want to have a look at is the dividends. That's the second variable. I'm just going it as it comes to my mind. There's no particular order. Is dividends. Now dividends can be calculated in a number of ways. Okay, so you must be on the lookout and you must be aware of how you can calculate dividends. It's not always going to be the same. One of the most common ways of calculating dividends is as follows. They give you the most recent dividends. And so in order to calculate next year's dividends, you take the most recent dividends and you grow it by the growth rate. That's one way. The second way to calculate dividends is they'll give you a payout ratio. So what is a payout ratio? A payout ratio is basically telling you what percentage of earnings or profit, same thing. So what percentage of earnings is distributed as a dividend? So therefore, if they give you a payout ratio, then you must think, okay, if they ask me to calculate dividends, in order to calculate dividends using the payout ratio, it will be as follows. Dividends equal payout ratio multiplied by earnings or profit for the year. So just be aware of that. But always keep in mind that you don't want the earnings of this year. You will need the earnings of next year in order to calculate the dividends of next year. So just be aware of that. Another way to work out the dividends is by using the dividend yield. So the dividend yield is calculated as follows. I'm just trying to think quickly. The dividend yield is dividend per share divided by the share price. So the dividend yield is the dividend per share divided by the share price. So if you want the dividend, you rearrange that equation by saying dividend per share equals earnings yield times share price, and that will give you the dividend per share. So just be aware. You need to be aware of all the ways that they can test the variable. I mean, you won't know all the ways, but the common ways. So, and then we go into the next variable is the growth rate. So there's about three typical ways of calculating the growth rate. In no particular order, once again, it is the linear formula, it is the compound formula, and then there is a sustainable growth rate formula. The most appropriate formula is the sustainable growth rate formula. but don't bother with it. You must know the formula, know about it. They're already going to test it. Like I think they've hardly ever tested it. So we're not going to go through the sustainable growth formula. You must just be aware of it and know the formula, but you don't have sleepless nights over it. So I'm not going to cover it. The linear formula, but you need to know when to use the linear formula and when to use a compound growth formula. You can't use it as you feel like. So you use the compound growth formula when they give you a number of years. So they tell you dividends in 2010 was 1 Rand. Dividends in 2020 was 10 Rand. Please work out the growth rate. So then you use the compound growth formula. Why? There's a number of periods, there's a number of years that this movement relates to. If you're comparing the growth rate from year one to year two, then you use the linear formula. So how do we calculate dividends? How do we calculate the growth rate when we're using the linear formula? It is simply as follows. Growth rate equals latest number divided by earliest number. So latest means this year, earliest means last year, minus 1. Okay, so that is the linear formula. The compound growth formula is a similar formula. So growth rate equals, open bracket, latest dividends, like in my example, 2020. I don't want to use dividends, you can use this formula for any growth rate. Okay, so let's just say latest number, which is 2020, divided by earliest number, which was 2010, close bracket. Then to the power 1 divided by n. So n is the number of years. So I think if we must calculate from 2010 to 2020, it's either 10 or 9 years. So you might just have a look how many years there are. So let's say it's 9 years. So then it is 1 divided by 9. So like, let me say it again. Open bracket, latest dividends divided by earliest dividends, close bracket, to the power of 1 divided by n, or 1 divided by 9, and then minus 1. Okay, so just be aware of that. That is the way you calculate the growth rate. Now, you only do all of these calculations if it was not given to you. Okay, so if it was given, you take what was given. If it was not given, you will have to calculate this. So that's the level you want to get into when you work through a question. Even if the question is as simple as possible, your duty to yourself is to run yourself through all the typical possibilities so that when you come to a question across it, when you come across a question of that nature, you have already covered it. How do you cover it? By constantly telling yourself the various scenarios that could um, confront you. So get into that habit. It's going to take a lot of time. But at the end of the year, remember, you're not preparing for now. You're not preparing to get done now. You're preparing for October. And obviously, to get to October, you need to make your test entrance exams. But ultimately, you're preparing for October. So when you come to October, you want to make sure that you are ready. So if you're going to rush through questions now, it's going to be a short-term gain for a detriment of the long term. So get into that habit of making sure you can think of various possibilities. You don't have to write them down, you don't have to do them, just to think about them. So when they do pop up, you are able to handle it. Or you have at least your brain will be aware of it. The last method is the bond yield plus risk premium. What is the bond yield plus risk premium? Is simply market rate or cost of equity equals bond yield. Another example of a bond yield is where they give you the yield to maturity plus a risk premium. They will tell you what the risk premium is. Okay. So those are the various methods, and that is what that can encounter, and that is what you can encounter. So for you need to run this through your mind consistently and constantly. So when you go to bed, after you've done your question, so for some of the guys that do multiple questions, let's say they work for 5, 6 hours an evening, when you go to bed, you must make sure that you actually run that stuff through your mind. It's going to help you. The and I'm not going to get into this, but just basically from a psychological point of view, um, when you whatever you put on your mind before you go to bed gets processed in your subconscious mind. So that, and remember, everything we do by reaction is from the subconscious mind. So you want to get to that point where when you read something, subconsciously, your subconscious mind is sending something to your conscious mind that's identifying what you're reading. So if you don't consistently remind yourself, your conscious mind is not feeding your subconscious mind. So that when it comes to the exam, your subconscious mind is not going to be aware of anything. So it's not going to be able to help your conscious mind. So that is why we talk about going through it consistently so that it gets ingrained in your subconscious mind. Every long term thing is in your subconscious mind, short term things in your conscious mind. So once it's in the subconscious mind, when you read, your subconscious mind is going to trigger with your subconscious mind. It's going to automatically send it to your conscious mind. And that's how you're going to start identifying things. So when you go to bed, and I'm telling you it works. So I read about it. Um, and when I read, so when recently, when I read about it, um, I believed it. And why did I believe it? Because without knowing about this whole subconscious mind, conscious mind mechanism of how your brain works, I tried it in when I was in second year. It was it's not part of the syllabus anymore, but basically I wrote a test where we were doing the revaluation on a depreciable asset. So just before the test, I studied it and I got it. When I went to the write the exam, I just went blank, and it worked on my nerves. So after the exam, I'm pretty sure you guys are the same. You all time like reminiscing over what you wrote in the paper. Can you remember what other people said? But basically, when I left the paper, I knew I didn't get that answer how it should be, and I all time played the scenario in my mind and played the journals, but I just couldn't get it. So before bedtime, I just went through it one last time without knowing anything, and I just went to sleep. When I woke up, I knew the answer because subconsciously, your brain makes connections while you sleep, and based on what you learn and what you are thinking, when you go to bed, you are resting, right? And your brain will make the necessary connections in your subconscious mind. So when you actually wake up, you have the answers what you want, and it works. I tried more than once, and that's what I'm saying why I believed it when I only read it now recently. So I did this in second year without knowing any scientific backings to it. I just did it for doing its sake, and it works. So whatever you're studying, try to constantly when you whatever if you're a person that drinks coffee, tea, water, not alcohol, because the connection with alcohol obviously is going to be hazy. Okay, so water, tea, whatever, and you're just sipping and drinking, and you don't know what to do, as opposed to just thinking nothing. Think about your learnings, and then hopefully that will start making connections. You are resting, you are relaxing while drinking coffee, tea, water, whatever else you want to drink besides alcohol, and that's going to help you. But you don't underestimate consistently telling yourself the same thing over and over and over. So when you do a whack question, when you come to ordinary share capital, tell yourself there are three methods to calculate market rate. Tell yourself the formulas for each of those three methods. Tell yourself the variables you will need to calculate those three methods. So when it does pop up, it's not going to be new. But that is what I wanted to cover over here. So I think was something else on my mind. No, so I think that is about it from a whack point of view. There was something else. But basically, that is from a whack point of view. We will now head over to the question and we will tackle the particular question. But before we do that, do you have any questions? Just so by the way, I'm not gonna let it be passive all the time. I'm going to ask for you guys input, whether you type it out to me via the chat or whether you preferably speak to me. But if you don't want to speak, you can via the chat. So I'm going to ask you because we need to make the class a little bit interactive. That's the only way I'm going to know. But I can see by the way, I can see who access the course, eh? So I know if you're going through the course or not. Well, I don't know what section, but I know when you access the course. So I know there's quite a few that didn't access yet. So please make sure you do. And if you have any questions, please let me know. And going forward, I'm going to ask you to respond to certain questions for me within the class. So before we go on, do you have any questions? Um, okay, Fakir, do you have any question?
No, no questions.
No questions.
Ryan,
No questions.
Lerato,
No question.
I'm not sure who's on Rankosa. Do you have any questions?
No, I'm good. Thanks.
Okay. So please make sure you actually identify those various aspects and constantly run that through your mind. That's also going to help you to identify um, which formula, if I can put it that way, you have not covered when you do a question. Okay. So now I'm going to do that whack question. You can get the Mac 4861, that later 2019, page 112. We'll go through that now. Okay, you should be able to see the scenario. I'm going to read it with you now. We're not going to read the entire question. We're going to read up until new proposal, and then we're going to read the additional or other information. So let's look at it. So it's a nice short question. Test 1, 2018, Mac 4861. Okay, so the level of CTA 1 and CTA 2 is basically the same when it comes to Mac. Hardly significant difference, if any. Same with accounting. The difference in accounting, there may be tested a little bit more topics, but when a particular topic is tested between the two, is basically the same. So during the course, I'll part of the lecture examples will be CTA 1, part will be CTA 2, depending on if the principles that is being tested is what I want you to know. Okay. So they say Edone is the holding company of a retail group listed on the Johannesburg Stock Exchange. The group manufactures and distributes clothing for men, women, and children, and only sells products that carry its own branding, which are sold to consumers through the Edone stores across South Africa. And the group currently has no plans to expand their retail footprint outside of the country. Products are currently manufactured in China due to the lower labor rates and flexible labor laws compared to South Africa. Okay, so there's just a high-level overview. You can see it is a listed client. and they a retail company that manufactures and distributes clothing. Okay, and then there's no plan to expand. So okay, outside of South Africa, not necessarily no, they do it, they're not necessarily not planning to expand at all, but not expanding outside of the country. And then we have there some products are manufactured in China, and they're giving you the reasons. Okay, so just be aware of that. So if there had to be a strategy risk management, then there are some kind of stuff in here, and then also some ethical issues. So I'm going to be in the FAQ 4862 question, test 1 2020. So I did the recording on the WAC question, so I uploaded sometime, maybe tomorrow, depending how long YouTube takes it. And I'm going to do the capital budgeting question and then the strategy and risk management question. So in there, they ask you about ethics as well. So here is a possible ethics type question when they're saying you're going to China because of the lower labor rates. So yes, it is lower labor rates, but the question is why? Are they using actually, what do you call that, child labor, whatever? So then that is an ethical issue. Okay, so just, so you might just, when you read these backgrounds, try to think of strategy and risk management type issues. And like I said, what they try to test within strategy and risk management, in that pistol thing, they add another E for ethics. So the next paragraph, technology has been critical to the success of the company and the group is reliant thereon to manage operations, manufacturing, sales, and reporting. Due to cost containment initiatives, there has, however, been limited funding available for capital investment in information technology, and this has resulted in increased system downtime. Okay, so there is some risk management issues over here. So now they're saying the following information relates to EDON for the year ending 28 February 2018. Very important in WAC, capital budgeting, as well as mergers and valuations. The date is very, very important. Without having a date, we won't be able to know at what point to perform the calculation. So the date is extremely important. So they're giving us a date, 28 February 2018. It doesn't mean they give us a date over here, that is the date. We'll have to have a look at the date based on the question. If there's no specific date in the question, then we will use 28 February 2018. So they say equity consists of 100 million ordinary shares of 50 cents each, issued at 120 cents per share, plus accumulated reserves. The shares currently trade at 230 cents per share on the JSE, with the required cost of equity at 24%. So here you can see that the market rate is given, the cost of equity is given, and hence we do not need to calculate it. If we had to calculate it, we have three options available to us. But because it's given, there's no need to do any calculation. So we have the market rate of 24%. We need the market rate as well as the market value. In this case, the market value, when it comes to ordinary share capital, we have two methods to calculate the market value. Either through the market capitalization method or through the dividend growth model. The market capitalization method says market value equals number of shares in issue times the share price. The dividend growth model says the market value equals D1, dividends of next year, divided by cost of equity minus the growth rate. Now here we can see we know the number of shares and we know the share price. So therefore we can use the market capitalization method. So the ordinary share capital line item is easy in this particular question. Let's go to the next bullet. The non-current liabilities of EDON comprises the following: 500,000 redeemable debentures of 50 Rand each. The debentures were issued on 1 March 2014 and are redeemable on 28 February 2020 at a premium of 5%. Interest at a rate of 8% per annum is payable on these debentures. Analysts believe the pre-tax rate of similar debentures to be 10%. When it comes to preference shares and debentures, when it comes to preference shares and debt, you always identify what was given, market rate or market value. In this particular question, the market rate is given. Why? They're telling you similar debentures to be 10%. So the similar is referring to market, and in this case, they're giving you a percentage, so therefore we know the market rate is given. That means we will most likely have to calculate the market value. In order to calculate the market value, or in whether it's market value or market rate, any calculation, whether it's market rate or market value, when it comes to preference shares and debt, we ask ourselves the question, is it redeemable or non-redeemable? It is redeemable if there is a specified date of repayment. It is non-redeemable if there's no specified date of repayment. We can see there's a specified date of repayment. We took it out on 1 March 2014, and we have to repay it on 28 February 2020. So there is a specified date of repayment. Okay, so that's important. So therefore, when we calculate market value, it's a redeemable, so we can use either the cash flow table or the 5 buttons on the financial calculator. Let's go to the next one. A long-term loan of 60 million Rand was obtained on 1 March 2016 from eDown's bankers. The loan bears interest at 2.25% above the South African prime rate of interest of 10.25%. Interest is calculated and compounded annually in arrears at the company's year end and is then capitalized into the outstanding loan balance. The loan is repayable in a single bullet payment on 28 February 2021. The market rate for similar loans is 0.5% above the contractual rate of the loan. The loan is a qualifying instrument in terms of Section 24J of the Income Tax Act, and consequently the interest is paid on the loan is deductible for taxation purposes. The company's practitioner already calculated the adjusted amount at 28 February 2018 to be 75 million for purposes of Section 24J. eDown adds a 3% hurdle rate for investment appraisal purposes. eDown plans on decreasing its dividend payout ratio from 28% in the 2018 financial year to 20% for the 2019 financial year. Let's go back to the Section 24J. At Section 24J, we can see we have a long-term loan. We can see what was given. The first thing we want to identify which of the market rate or market value was given. Once again, the market rate was given. So we most likely have to calculate the market value. When we want to calculate the market value, we ask ourselves, is it redeemable or non-redeemable? In this case, it is redeemable because there is a specified date of repayment. So therefore, we can either use the cash flow table or the financial calculator. When there's a Section 24J, you can't use the financial calculator. You will have to use the cash flow table. Okay. What is Section 24J? Section 24J is just a way of how SARS calculates the interest that you can deduct. Typically, we assume no Section 24J, but in reality, in order the interest that you can deduct have to be calculated in terms of Section 24J. We will cover how to go about how to do it. Just an important thing to note, that adjusted amount that they gave us at 75 million Rand, for CTA 1, you will not be required to calculate it. They will give it to you. For CTA 2, you must be able to calculate that number. So in the 2020 test 1 paper, and there's a, not 2020, yeah, in 2020 test 1, there is a Section 24J calculation. But when I upload the video, you can watch it. and you have to calculate that 75 million. It's not 75 million in that question, I'm just saying, like in this case. So what did they call it? They called it something. The company already calculated the adjusted amount. So the 75 million rand, that adjusted amount, in CTA 1, you don't have to be able to calculate it, it will be given. You must just know how to use it. In CTA 2, you must be able to calculate it and obviously also be able to use it. Okay, so that is that over there. That 3% hurdle rate. What is a hurdle rate? This only applies to investment and capital appraisal. So that means when we perform a capital budgeting question, then we must apply a hurdle rate of 3%. A hurdle rate just means you add or subtract. In this case, you add 3% to the general WACC rate. So the general WACC rate is the general cost of finance to the company, and that's what we're going to calculate. But when you do an investment appraisal, the company don't just use the WACC rate, they use the WACC rate plus a hurdle rate, and in this case, the hurdle rate is 3%. Companies use a hurdle rate for multiple reasons, and two typical reasons. Number one, just to ensure that they, for purposes of risk, just in case they maybe made a mistake, or just to add a buffer. And then another reason would be if they're going to different markets. So, for example, the WACC of Woolworths is in South Africa, but they're also in Australia. So let's say the main operations is in South Africa, which it is, so they'll most likely have a WACC rate for South Africa. That's the general WACC rate of Woolworths, but it's applicable to the South African environment. When they go over to Australia, they can't use the WACC rate of the South African operation because the risks over here is very different to the risks and opportunities in Australia. So based on what Woolworths board decide whether Australia is more riskier or less riskier, they will adjust the general WACC rate for that risk. So if it's less riskier, they will reduce the WACC rate in Australia. If they perceive Australia to be more riskier, they will adjust the WACC rate upwards. So that is basically a hurdle rate, okay, where you adjust a particular, your general WACC rate. Okay, so just be aware of that. So you're not going to need your new proposal, that is for capital budgeting. Other information, the corporate tax rate and the prime interest rate is 28 and 10.25% respectively. And these are expected to remain at these levels over the planning period. Okay, so point one. So required A1, calculate the weighted average cost of capital of EDON on 28 February 2018 based on market values. Okay, so you need to calculate WACC. Then they're giving you two further sets of information. Number one, the date, 28 February 2018, and then the second thing, based on market value. Even if they don't tell you based on market value, you must use market value. Okay, so if they don't give you a target capital structure, there's no need for them to say based on market value. You must know, you must use market value. That only becomes very important if a target capital structure is given. So if a target capital structure is given, the assumption is that you must use the target capital structure. But if the required says use market values, then you can say, dear examiner, the target capital structure is the most appropriate, therefore I'm using a target capital structure. Even if that is correct, they didn't ask you for target capital structure, they asked you for market value. So just take note of those kind of subtleties. So there's three important parts in that required. Calculate WACC at 28 February 2018 using market values. Okay, so that's the three things. What's the market values for? To determine your capital structure. Now, the moment you see calculate WACC, two things go through your mind, the formula and the table. Once you have the formula and the table, the next thing that goes through your mind is to identify the sources of finance, the components of capital. There's three in this example: ordinary share capital, what was that other stuff now? Long-term loan, and debentures. Okay, so That's the three sources of finance. So now we're going to head over to Excel, and then we're going to cover the question. I just want to open up Excel quickly. While I'm opening up Excel, do you have any questions? Can you see Excel?
Not yet.
Should be able to see it now.
Yes.
So they said, dear student, please calculate WACC at 28 February using 2018 using market value. So let's have a look. What is the first thing you do is to write down the formula. WACC equals cost of equity multiplied by its weighting. How do we determine the weighting? Value of equity divided by value of equity plus the value of debt. I'm going to put this in big brackets plus cost of debt after tax multiplied by the weighting of debt. How do we calculate the weighting of debt? Value of debt divided by value of equity plus value of debt. So let's go through this. Let's try to break this formula up based on the three things that we need. We need the components of capital or the source of finance. We need the market rate and we need the weighting. So the sources of finance we can see over here is equity and debt. Okay, so these are sources of finance. More specifically, we need to list the specific source of finance. We don't need to write that formula out like that. All we're telling them, it is the source of finance of equity plus a source of finance of debt. The second component is the market rate. Here we can see cost of equity. That is the market rate of equity. The cost of debt, that is the market rate of debt. And remember, we will take 1 minus t because there's a tax deduction when it comes to interest payments, while there's no tax deduction for a dividend payment. Therefore, cost of debt is 1 minus t, whereas cost of equity, there's no tax deduction. Third, it is the weighting. So as we can see from this calculation, we can see over here, value of equity plus value of debt. Value of equity plus value of debt, that represents the total sources of finance. That represents our total capital structure, which is our total long-term source of finance. So by saying value of equity divided by our total long-term finance, that is saying what percentage of equity, what percentage of our total capital structure is funded through equity. Similarly over here, value of equity plus value of debt, that is our total capital structure, which is our total long-term sources of finance. By saying value of debt divided by total capital structure, we are saying what percentage of our total capital structure is funded through debt. That's our weighting. Okay, so just to give you some idea of the formula and that you don't feel intimidated by all those letters. Here we're going to say WACC is. When we get the answer, we'll just plug it in over there. Now, the next thing is to sort out to set up your table. We're going to have your components of capital or you can call it source of finance. Then we'll have market rate. You can set up from market rate onwards how you want to. I usually start with market rate. Then I would have market value, and that will give me my weighting. Once I have my market value, I'll be able to determine my weighting, and then I can get WACC. I want to do some formatting quickly, so it just looks a bit neater. Okay. Okay, here we go. Oh, just for market rate, I just like to indicate that this is after tax. Okay. Then WACC is A multiplied by B. Okay, so WACC is basically WACC is equal to A times B. Okay, that's just for our purposes. So once we have our capitals, once we have the formula down, and once we have the table set up, the next thing is to list your components of capital, to list your sources of finance. We already identified that we have three sources of finance, and that is ordinary share capital, what was the other one? Redeemable debentures, and then long-term loan. Okay, so this is going to give me my total. So that will give me my total. We have no more source of finance, and that will give me my total. So I will just call it total. Okay, now we can go about doing our calculations. If you remember from the scenario, ordinary equity was given first, and what was given in that paragraph was that the cost of equity is 24%. So now I can just say 24%. Okay, so that was given, plug it in. There's no need to smile. There's no need to celebrate. Just plug it in. Don't wait. Okay. So that is cost of equity. Now we need the market value. It was not given to us, and hence we need to calculate the market value. In order to calculate market value, we have one of two approaches, either market capitalization or dividend growth model. We know, given the scenario, we can use the market capitalization method. So over here, I'm going to have my workings. So here we will have workings. Okay, so make this my, okay. So here we're going to have our working. So working one, we're going to calculate the market rate of equity. So market value or value equals number of shares in issue, number of shares in issue multiplied by the share price. Okay, so here I'm just going to say value number of shares in issue, and then share price. What's important to note, it is not any shares, it is the number of shares in issue. It is not the authorized number of shares. So be aware of that. So I want the value. So what I'm highlighting in green is my answer. So the number of shares in issue was given to us as 100 million. So 100, 1, 2, 3, 1, 2, 3. So let's go have a look quickly. So there we can see equity consists of 100 million ordinary shares. Share price currently trading at 230 cents. So 100 million shares. So I'm going to check that it's 100 million. Yep. share price 230 cents. So this is equal to 230 divided by 100 to convert it into rands. So basically it is 2 rand 30. So if I say number of shares multiplied by share price, remember it's the current share price, so that's my market value. So I'm going to say equal to 230 million. We're happy with that. Where did I get it? If it is in the event it is wrong, I got it from working one. So let's recap ordinary share capital. We have identified the source of finance, which is ordinary share capital. So now we know we need to go on to the next two parts. Number one, the market rate. Number two, the weighting. The way we calculate the weighting, because it was not given, is through market values. And because the question told us, use market values. So now we know we're going to we need market value. We need market rate and we need weighting. But the way we're going to determine the weighting is through market value. So for ordinary share capital, the market rate can be determined in three ways if it is not given. It was given, so we just plug it in. But if it was not given, there's three methods we can calculate it. Number one, CAPM method. Number two, dividend growth model. Number three, bond yield plus risk premium. For market value, there are two methods. So it's either given, and if it's not given, there's two methods. It was not given, so we needed to calculate it. So how can we calculate it? Either through the market capitalization method or through the dividend growth model. In this case, we were given information in order to calculate it using the market capitalization method. Why? Market capitalization requires two things: number of shares in issue and the current share price. We were given both, so we just use that. Okay, so that's the level of thinking you want to go through. It's either given or you have to calculate it. Even if the number is given, tell yourself, what if it was not given? How would I have to calculate it? Okay. While you do the question, you can just go through that high level, but at the end of the question, you then want to say, okay, for ordinary share capital market rate, I know it was given, but it could have been calculated in one of two ways. If it was capped in one of three ways. If it was CAPM, what is the formula? What would I need? If it was dividend growth model, what is the formula? What would I need? If it's bond yield plus risk premium, what is the formula? What would I need? For market value, it's either given or we calculate it. If we have to calculate it, there are two methods. Market capitalization, what's the formula? What would I need? Dividend growth model, what's the formula? What would I need? That is what you're going to do time and time and time again till it comes to a point where you know whack inside and out. Okay, so get into that habit. It's going to take time. It's not going to be quick, but ultimately it's going to be thorough training. Okay. Next, we're going to go into redeemable debentures. Now let's read the scenario. Remember, when it comes to debt and preference shares, you want to identify what is given, either market rate or market value. In this case, we know for both the market rate was given, therefore we need to calculate the market value. Once we know what was given, we will know what we need to calculate. Whether we have to calculate market value or market rate, the thinking process for the calculation is redeemable or non-redeemable. So let's move over. So the redeemable preference shares, analysts believe that a similar debenture, when you see the word similar or currently trading, then you must know that is the market value. Okay. And in this, that is the market number, either market value or market rate. In this case, the market rate, 10%. So what we're going to go, we go to our table, we plug it in, equals 10%. But what do we know? That this is debt. Any debt instrument, we can deduct the interest expense, and therefore we can multiply this by 0.72. So that is our market rate. Now, we need to determine the market value. So if we go back to determine the market value, we identify whether it's redeemable or non-redeemable. We know it is redeemable because it is a specified date of repayment. So therefore, we can either use a cash flow table or the financial calculator. You can only use the financial calculator if you can plug in so you need, so remember that the financial calculator has 5 things. One of it will be the required, so you'll need the other 4 things. If you can plug in the other 4 things, then you use a financial calculator. But if you can't, so for example, if the payment is not the same every single year, then you can't use the financial calculator, because with a financial calculator, you're assuming every year the payment is the same. That is why with the Section 24J, you can't use the financial calculator, because as a result of the tax savings is different every year. So therefore, the ultimate payment will be different every year, and hence you won't be able to use the 5 buttons on the financial calculator. You can still use a financial calculator, but you'll have to use a cash flow function on the calculator. So that is why we set up a cash flow table. Okay. So in the redeemable debenture, we will use the financial calculator. I'll show you why we can use a financial calculator, because all the numbers we can determine. So we want to get the market value. The market value on the financial calculator is PV. So if I go over here, working 2, we want the present value, which is the market value. So therefore, we're going to need the future value. We're going to need PMT, we're going to need N, and we're going to need I. Remember, this WACC rate is determined as at 28 February 2018. Very important. Okay, so this is what we're trying to calculate. That's what we're looking for. What is PV? PV is the market value current, or current market. So it is the value today, it is the current value, it's the market value. This year, FV, which is the future value, this is our nominal value plus or minus premium or discount. Okay, so if it's a discount, you minus. If it's a premium, you plus. Payment is calculated as nominal value multiplied by the coupon rate. Remember, they'll generally give you 2 rates, a coupon rate and a market rate. The coupon rate is the rate agreed upon between you and the bank. So whatever rate you and the bank agreed upon, whatever the contractual rate is, that is the coupon rate. The market rate is just a rate, it's just a similar rate, or a rate that you would obtain today if you were to take that exact same contract out today. So what is the market rate? The market rate is saying, if this exact same instrument is taken out today, what rate would I get? So that's the market rate. Do not confuse market rate with coupon rate. You use the coupon rate to determine PMT, payment. You use the market rate to discount any future cash flows. N is number of years times number of payments per year. So in this case, we took the thing out 1 March 2014, up until 2020. So let's say that is 6 years, and each year there's 1 payment. There's not a physical payment. I'm going to check what is your payment. Whatever we'll see now, there's 1 payment. So therefore, it is 6 times 1, which is 6 years. I is the market rate. I is the market rate. Okay, so let's be aware of that. So let's have a look. They're saying the non-current liability comprises 500,000 redeemable shares at 50 Rand each. So the nominal value, the face value is the same thing. So in this case, the nominal value is 500,000 debentures times 50 Rand. The The debentures were issued on 1 March 2014 and are redeemable on 28 February at a premium of 5%. So therefore, the future value is nominal value plus 5%. So let's go and work that out. So if we go back, the future value is equal to 500,000 debentures, 1, 2, 3, times 50 Rand. That answer is the nominal value or the face value. So this inside of brackets is the nominal value or face value. But remember, we need to take into account it's plus a premium. There's a 5% premium. So therefore, we're going to say plus 5% on that. So we can just basically say multiplied by 1.05. Okay, so that is our future value. The PMT is a payment over here. Let's just see what they said. Redeemable, and the interest at a rate of 8% per annum is payable on these debentures. So you can see we pay, there's one payment per year. So we'll go and say payment nominal value times coupon rate. So the nominal value, 500,000 debentures, 1, 2, 3 times 50 Rand, multiplied by the coupon rate, which is 8%. So my payment is 2 million Rand. Then N. What's important, we are working from the current date going forward. Our current date is 28 February 2018. And going forward is up until 28 February 2020. So there's 2 years left. So the remaining number of years, actually, let me just change this to number of years remaining. Okay, so number of years remaining, 2 years. Number of payments per year, 1. So N is 2. So I'll say equals 2 times 1. Okay, and then the market rate is 10, what was it, 10%. 10%. Just an important note over here, for some of you that may wonder where I've picked it up. The payment and I must be in the same, must be the same in terms of either before tax or after tax. I just keep it whichever one is given. So before tax, so because I kept payment before tax, I will be before tax. If I want to have it after tax, then both payment and I must be after tax. Just make sure whichever one you choose, it is fine when you want to work out the present value. So I had my payment before tax, so I must also be before tax. So now I'll say present value. They want the rate, which is 10%, N, which is 2, PMT, which is 2 million, future value, and then type. So all payments happen at the end of the period. So I put 0, and then that's my answer, 25 million Rand. So now I can go plug it in, and I'm going to say, just make sure it's positive. So remember, future value and payment will be in the same direction, either both negative or both positive. And then present value will be in the opposite direction to future value. So that is why the answer came out to be negative. That's just how the formula works. But remember, you don't go plug it in negative over here, you plug it in positive. Once again, if that happens to be wrong, they can find it under working 2. Now we're going to work out the long-term loan. With the long-term loan, let's have a look. Once again, it is a debt. Preference shares and debt, you first determine what is given. Market rate, market value. We know the market rate was given. Let's go have a look how much is the market rate. They said the market rate for similar loans is 0.5% above the contractual rate. So 0.5% above the coupon rate. The coupon rate is 2.2% above the prime rate. So therefore, we can go plug that in. So if I go over here, so I can just say it is equal to open bracket. Prime rate, 10.25%. My contractual rate is 2.25 above prime, so it's 10.25% plus 2.25%. And the market rate is 0.5% above the coupon rate. So at that point in time, that is my coupon rate, which is going to be 12.5. So my market rate is 0.5 above that, so 0.5%. So in effect, my market rate is 13%. But remember, we need an after-tax rate. So therefore, I multiply this by 0.72. You can also work it out if I have to work it out, but you can also do the working separately, okay? Which will probably be safer from an exam point of view. So that's my market rate. Now I know I need to calculate my market value. My market value, redeemable, non-redeemable. We know it is redeemable. So therefore I can use either cash flow table or the perpetuity on the cash flow table or the financial calculator. Because of section 24J, I won't be able to use the financial calculator. So I'll have to use the cash flow table. Okay, so this is how you will calculate a present value using section 24J. There'll be three parts to the calculation, and we'll explain that now. So let's go into that. So working three. So for working three, let's have a look. I'm going to work, so I need details, and I'm gonna need year 0, and I'm going to read the remaining period. So let's go have a look. What's the remaining period? We are at 28 February 2018. There is one annual payment, so they say calculated and compounded annually in arrears. So that means there's one compounding period per year, and the thing comes to an end 28 February 2021. So therefore, it's 3 years remaining. So year 0, 28 February 2018, 2019, 2019, 2020, 2021. So there's my 3 periods. There's going to be 2 parts in this thing. It is the loan repayment, and there's going to be a tax savings. So remember, you get a tax savings when it comes to paying off debt. So therefore, we're going to call it tax savings. So that's what we're going to get. Then we can have over here. Then we'll get our net cash flow. And then we will have discount rate. And then you will have NPV or NPC. Because it's finance, we'll call it NPC. Okay. And then that will be the answer. Okay, so that is what we are looking for. Now, we have to work out the loan repayment. We will have to work out the tax savings. And that's where the next calculations come in. So I'm going to work out the loan repayment using working 4. And I'm going to work out the tax savings using working 5. So let's get on to working 4. So with working 4, we're going to work out the loan repayment, which is the bullet payment. Okay. Here you can use your financial calculator. So what do we want? We want to work out the payment at 28 February 2021. So we want to work out the future value. In order to work out the future value, we're going to need the present value. We're going to need PMT, we're going to need N, and we're going to need I. So that's important. Now here's important things to take note. To calculate the future value, we're going to need these 4 items over here. So those 4 items is you use the information based on where you have all the information. And generally, the date you're gonna have all the information is the date you took out the loan. So we will see now in this scenario, if we have all the information as at the date we took out the loan. But before we get into the calculation, this is an important thing to take note. This future value represents the amount we're going to have to pay the bank at the end of the loan term. So that's extremely important. That future value represents the amount that we have to pay the bank at the end of the loan term. So let's go see if we can find present value. Let's see if we can find PMT. Let's see if we can find N. And let's see if we can find I. Remember, no matter which date you calculate it at, the future value will remain the same. So we will take the information based on the date that we have all the information for all four variables. So they say a long-term loan of 60 million Rand was obtained on 1 March 2016. So there we have a present value of 60 million Rand based at 1 March 2016. The loan bears interest at 2.25 above the prime rate. We know that. Interest is calculated and compounded annually in arrears at the company's year end and is then capitalized into the outstanding loan balance. What they're trying to tell you over here, that there is no physical cash annual payment. You work out interest annually and then you capitalize it to the loan. So if you think in terms of financial reporting, the journal entry will be as follows: credit loan to bank, debit interest expense, and not credit bank, debit interest expense, because we're not paying the interest to the bank, we are capitalizing it to the loan. So that's important to note. So at every year end, the bank calculates interest and adds it to the loan. So just be aware of that. And how do they calculate interest? Based on the agreed upon rate, based upon the contractual rate, based upon the coupon rate. And what is a coupon, contractual or agreed upon rate? It is a 2.25 plus 10.25. So therefore, in this scenario, there's no payment. Payment is zero. And because we know we're going to pay back at 28 February 2021, we can see that we have all the information as at the date 1 March 2016. We have present value, we have I, we have PMT, and we have N. So from 1 March 2016 up until 28 February 2021 is how many years? So 1 March 2016 to 28 February 2015. 2017 is 1 year. So 28 February 2017 is 1 year. 2018 is 2 years. 2019, 2020, 2021. So it's 5 years. So that loan has that full loan is a 5-year period. So if we go over, as at 1 March 2016, the present value was 60 million Rand. 1, 2, 1, 2, 3. Just so see whether the numbers are putting proper zeros. So there we go, 60 million Rand. The present value, 60 million Rand. PMT, there's no physical cash payment, so we'll make it 0. N, there's an annual so the number of years is 5 years. The number of compounding periods is 1, so N is 5 times 1. And then we have I. Now, this is where we must keep your head straight. And that is why it's important to understand what are you trying to achieve. We are trying to achieve the value that we're going to have to pay the bank at the end of the 5 years. So the way the bank calculates that is by compounding interest. And the rate that they use to compound interest is the coupon rate. So therefore, the I we use over here is not the market-related rate, but the coupon rate, the agreed upon rate, the contractual rate, which is equal to 10.25% plus 2.25%. So if I do the future value is equal to future value, I want the rate, I want N, I want PMT, I want future value, I want present value, and then I want type. Remember, the interest is compounded annually in arrears. That means at the end of the period, so I put in 0. So at the end of 5 years, I'm going to pay 108 million rand. So therefore, based on our calculation, in 3 years' time we're going to have to pay that. So in year 3, because we are at 28 February 2018, so that is in 3 years' time. So our loan repayment will be 108. Because of the payment, I'm going to make it negative. So that is how we calculate the loan repayment, what we're going to pay the bank in 5 years, what we're going to pay the bank at the end of the loan term. So what is important? We had all the information as at 1 March 2016. So therefore we worked out what we're going to pay the bank using that information. If you wanted to use it, we wouldn't be able to because we don't know the future, the present value at 28 February 2018. So therefore we didn't go that approach. Now you're going to work out the tax savings. The tax savings in terms of the tax savings in terms of what now? In terms of Section 24J is as follows. So the tax savings in terms of Section 24J is as follows. We must calculate interest. So interest equals present value multiplied by I. Okay, so if you read Section 24J, the formula in Section 24J says A equals B times C, something like that. Okay, so A representing interest, B representing the coupon rate, and C representing the adjusted amount, which is the present value. So the present value is known as the adjusted amount in terms of Section 24J. So that is how we determine interest in terms of Section 24J. Okay, so let's have a look. So why is it important? Every single year or after every compounding period, the present value changes. Because after every compounding period, the present value change, interest will change. So that is the difference between Section 24J and non-Section 24J. Okay, so just be aware of that. So here you can see in working 2, there was no Section 24J, so there was no need to do this hectic calculation, whereas for the long-term loan, there is Section 24J, so we need to go through this long process. So the way we will do it, we'll put in the date or the period. So I'll just put in the date. Then we're going to have present value. We're going to have the coupon rate, which is I, coupon rate, and present value times the coupon rate gives me interest. But remember, the interest forms part of, gets deducted from the taxable income. Ultimately, what SARS gives you is not the interest, but rather 28% on the interest. So therefore, we're going to say tax at 28%. So the first compounding period will be 28 February 2019. 28 February 2019. Because remember, we are as at 28 February 2018. So that has already taken place. Now, 1 year later, there will be a compounding period, which is 28 February 2019. The next one, 28 February 2020. And then the last compounding period, because it's annually in arrears, 28 February 2021. It makes sense. The loan comes to an end on 28 February 2021. Interest is compounded annually, and there are 3 years remaining. So the last compound, the last interest is capitalized on the last day. There is 3 years remaining, and we only compound once per year, so therefore we expect 3 dates. If we compound it twice a year, we'd expect 6 dates. If we compound 4 times a year, we would expect 12 dates. So just be aware of that. Now this present value in the MAC 4862 test, 2020 test 1, you needed to calculate this number. This is CTA 1. So this number will be given. So it was given to us as that 75,937,500. 75,937,500. So I'll go plug it in, 75,937,500. So now we know the adjusted amount as at 28 February 2018. The coupon rate will remain the same. What is the coupon rate? It is that 12.25. The agreed upon rate, the contractual rate. So that will remain the same throughout. So I'm going to make this F4. So now absolute value it. So I can just drag it down. There we go. So using the formula, interest is present value multiplied by the coupon rate, 12.5. So that means over here in 2019, the interest deduction is 9.4 million. But that's not the tax savings. The tax savings is that number, the interest multiplied by 28%. To get the new present value, as a CTA 1 student, you are required to be able to get the new present value. So it's going to be your present value, the previous present value, plus this year's interest rate, interest capitalization. Then we can calculate the interest for 2020, and then we can calculate the tax savings. Once again, you must be able to calculate. It is going to just drag it down, which is the last period's present value plus the next period's interest. Okay, and that is that. So there we go. As you can have a look, if you add the latest present value plus the last period's interest, it will add up to the repayment amount of 108,121. So now you know that our 108,121 is correct because it's adding up to the present value plus the last interest payment. So now I'm happy that our loan repayment calculation is correct. So now we can go plug in. So the tax savings is this answer over here. That's the tax savings. We go over here and we say tax savings in year 1 is at 2.6. Tax savings in year 2 is a 2.9. Tax savings in year 3 is the 3.3. Now we can get our cash flows, which is the sum. Before I go on, you can see I made the loan negative because and the tax saving positive. The tax savings reduces the loan payment. Okay, so just be aware of that. Tax savings is a good thing as an inflow, so it's positive. So that's my net cash flows. Now I can use a discount rate. Remember, now we're coming into financial management where we are discounting future cash flows. When you discount future cash flows, you use the market rate. And the market rate, what was the market rate again? The market rate is at 9.36. So I'm going to go fetch the market rate of 9.36. An important aspect to note over here, what's important to note over here is the following. That this rate must be after tax because this cash flow is after tax. How do I know this cash flow is after tax? Because there's a tax savings over there. So because the cash flow is after tax, the discount rate must be after tax. If the cash flow is before tax, the discount rate will be before tax. Now I get my NPC. So NPC, we use the Npv formula. So Npv, my rate 9.36, value 1, value 2, value 3, and that means my cost of the present value or the market value of that loan is 75 million. So now I can just go and plug it in. So here I'm going to say equal, I'm changing it to positive because we want a positive number. It is 75 million rand. Now I can add up all of these market values. So that total, the 330, that is my total capital structure. That is my total long-term source of finance. So to get my weighting, value of equity divided by total capital structure, which is 70%. I can just drag it down. I just need to make sure that it adds up to 1. So I'm happy that over there, it is redeemable, the value of debentures divided by total capital structure. Similarly, it is the long-term loan divided by the total capital structure. Now I can work out WACC. WACC is A multiplied by B. And similarly over there, so now if I add it up, a weighted average cost of capital is 9.39. So that's basically how we go about doing it. And that is how we calculate the market value under section 24J. Two parts, the loan repayment and the tax savings. The loan repayment, we use this formula, the section over here, and then the tax savings is similar to an amortization table. Okay, if you look at the UNISA solution, you'll probably get very confused. So it's your choice, but I would suggest you use this. I don't think you'll be as confused. But it's your choice, obviously, and that's basically how we do this. So remember the way I told you how to think through ordinary share capital. You must do the same for preference shares, same for debt. When you cover preference shares and debt, you just cover it under one section. You do it the exact same way. The only thing is you won't have section 24J for preference shares, because preference shares is an equity thing, whether it's classified as a debt or equity from an accounting perspective. From a SARS perspective, preference shares is equity, so there won't be any section 24J deductions. Section 24J only applies to debt, but you must just think through these various aspects. Why these various aspects are so important, particularly from a CTA2 point of view, you may not always be required to calculate the number. You may be given a scenario where the number was calculated already. Perhaps you're the new finance manager, or there's someone else that did the calculation and you need to review it. And in some cases, the FD did the calculation and you need to review it. So the calculation is done already, and you have to review or evaluate it. And in order to do that, you have to pick up any errors. So for example, in the test 1 2020 MAC 4862 question for capital budgeting, the capital budgeting scenario has been given and you have to evaluate what is the problems. And when I just looked at it 2 minutes, and I could pick up number of issues. So when I'm going to record that and then I'll share it with you guys. But basically, as you think through everything, you must be able to understand the whys and what to expect. Because if they do give you a calculation, you must be able to evaluate it. A good check to see whether you really know your stuff is as follows. if you can only perform a calculation from start to finish. So if you can only do WACC by performing the calculation, there's a problem. Secondly, if you can only do WACC by performing the calculation from start to finish, that's also a problem. You need to be able to do three things at the minimum. Number one, actually four things. So number one, you must be able to calculate WACC from start to finish. Number two, you must be able to complete a WACC calculation. So that means someone started it, they left, they resigned, and you have to complete it, or they got sick, they have COVID, and you have to complete it. So that means it's partially completed, you have to take it from there and complete it. So number one, the easiest level is to complete the WACC start to finish. I'm using WACC now because we're covering WACC, but this applies to anything, whether it's finance, whether it is accounting, whether it is tax. So you must be able to complete it from start to finish. That's the easiest level. Second, you must be able to complete a WACC calculation that is partially completed. Number three, you must be able to evaluate a WACC question. It's completely done, and you have to evaluate its accuracy, completeness, and fundamental correctness. Okay, so for example, they could have done this over here where they put in the redeemable debentures, but they put in a before tax rate, or they put in the coupon rate. So you must know this should be a market rate, and you should know this would be after tax. Here they could have put in, let's say, the dividend yield, and but you don't want the dividend yield. You want the required return from shareholders. You want the cost of equity, not the dividend yield. And it could have been after tax, but you know it must be before tax. So that is critically evaluating. In the market value, they'll test us extensively. They'll probably not do it in WACC, but they'll do it in valuations, where they give you a valuation and you must evaluate it. So that's the third. The fourth, which is probably the most challenging, and that is to document the WACC calculation by discussing, writing about the WACC calculation. And it's on one of two levels. Number one, which is the easier of the two, where you're writing to the CFO or the finance manager, meaning you're writing to someone that have a finance background, and hence you can use finance terminology, finance lingo. The next one, which is the harder one, where you're probably writing to the CEO or to the board. And the CEO or the board may not have a technical finance background. Remember, the CEO and the board must have finance knowledge somehow or another, but it does not have to be technical. So you could be in a construction industry and the CFO is an engineer. The CEO is an engineer, or the chairman of the board is an engineer. So he does not need to know all the technical knowledge of finance. He'll have a high level overview. So when you talk to him, he might not know the terminology, but if you talk it in layman's terms, he will understand. So that is the second level. So that is why I always tell you, think about what you're doing, reflect about what you are doing, and constantly tell yourself how you can do certain things, because they can easily throw you with that. And so that is why make sure you can complete the calculation start to finish. You can complete the calculation that is partially started. You can evaluate a question, critically evaluate or review a completed question. Another way of doing it, spot the error. Number four, the fourth one is to document, but the document can be in two ways, either to someone with a finance background, like so a CA or something, or someone that is a non-CA, non-finance background. They will still have an idea. If they are CEO or board, they are required to have some financial background, but they may not know the technical jargon. Okay, so particularly in accounting, you can talk about impairment, or you can talk about whatever was some technical thing. If you use the word impairment, you must tell them what that even means. When you talk about if you like, for example, at Signium, this you probably know who the CEO is. She's very vocal. So Magda, no matter how smart she don't know what is a foreign what was it? Is it? She doesn't know what is a foreign exchange. So when she sees something like that, she goes crazy. So what we do, we hide it in the numbers so she doesn't see it. Because if she sees like foreign exchange, what is this? You understand? Like she wants to see stuff that is real. She doesn't see accounting things. So all we do is we either change the name so it's understandable to her when she reviews, or we just lump it into another number so that she doesn't see it. So well, obviously the FD knows about it, but just so that she doesn't go crazy. So, but that's the important aspect. Like, so as you can see firsthand, you see she's smart. She knows business. She what you call it. But when you see an accounting thing like that, she like can't understand what that is. She basically wants it out, but we know we can't take it out because it has to be there. So we do take it out from a site, but we just put it in somewhere else. So um, that is important. Remember, from a board two perspective, if you're thinking long term, from a board two perspective, um, I'm not she, from a board two perspective, that is an important thing that they will test. So be cognizant of who, if you must discuss or write a memo, write a letter, whatever it is, or an email, who you're addressing in terms of qualification and so forth. But anyway, that's all from my side. Do you guys have any questions?
No questions.
Saeed,
No questions.
Kashita, Karato, Ryan, who's finance and COSA?
No questions.
It's Nasreen from finance.
Oh, okay, necessary. Okay. Okay, so explain working three after the discount rate. So let me go there. Working three, where's this now? There we go. Working three. This year. Okay, so while we have, we just see what does it require, what's the question? Let me just share the Excel. So working three, what is just here? So you just want working three. Okay, so this discount rate over there, just I'm not sure if I understand the question, but basically, so in working three, we're putting in the loan payment, we're putting the tax savings, okay, and then we're getting the net cash flows. How do we get the net cash flows? Summing up all of these, we're getting the net cash flows. Then with the discount rate is after tax. The reason why it's after tax, because the cash flow is after tax. The cash flow is after tax, and the discount over here, because we are discounting future cash flows to its present value, we're using the market-related discount rate. Then to get NPC, I use Excel and I use the Npv formula. So in the Npv formula, we put in the rate first, which is 9.36. Then I put in value 1, value 2, and value 3, and that gives me my Npv. My answer is going to be negative because the loan repayment is a huge number, which is negative. But when we put into the WACC calculation, we just want to get the fair value or the market value of the finance, so we make it positive. If you use this on your financial calculator, if you do this on the HP financial calculator, you will use the cash flow function. So how you'll type it in, you'll go second function, clear all. Okay, so everything is cleared. Just ensure that your financial calculator is 1 per year. So you say second function, clear all, then 1 per year must appear. So now you know your calculator is 1 per year, and you know all prior calculations have been cleared. Then you say 0 cash flow. So why 0? Because the financial calculator Excel starts from year 1. The financial calculator starts from year 0. So we're putting 0 cash flow. Why 0? Because in our calculation, year 0 is 0. Then we will put in the next answer, 2.6 million cash flow. What will appear is that 2.6 million is appearing, and then you will see cash flow 1. Then you will go 2.9 cash flow, and then you will see cash flow 2 appear. Then you go 104, you press the plus minus button because we want it to be negative, and then you press cash flow, and that will be cash flow 3. Now at that point, you have put in all your cash flows. Then you will go and you'll say 9.36, and you'll press the I button on the financial calculator, that I on the one with the 5 on top, whichever is I, you press that. Then you say, so now at this point, you have all your cash flows and you have your discount rate. Then you go second function and you press NPV, and you should get to the same answer. Does that answer your question, Ashita? Okay. Any other questions? We're going to do some spot checks from next week. So, for example, you must talk me through how would you think. Remember, I'm more concerned about your thinking process, how you think, how you approach. The reason being is, if I can see you have the right thinking approach, then it's great, because then we just work on some of the theory. But if the thinking approach is not up to scratch, no matter how well you know your theory, it's going to be easy to get confused in a complex scenario. So I focus on approach so that I can see, okay, you're at least on the right thinking. I focus on, do you know the big picture? And then once you have an approach, once you have the big picture, then you can focus on all the nitty-gritties. The nitty-gritty is important because that's going to get you to pass. But if you don't see the big picture, if you don't have a thinking approach, whether you know the nitty-gritty is also not going to pass, because you're not going to be able to navigate the scenarios. So that's what I'm going to see. So when I ask you, take me through WACC, you want to say, okay, when I go through a WACC question, I know what I'm trying to achieve. I'm trying to achieve the general overall cost of finance to the business. In order to calculate WACC, I need 3 components. It is my source of finance or components of capital, my market rate, my weighting. My source of finance represents my capital structure, which is my long-term source of finance. And typical examples are, so it's made up of debt and equity, and typical examples, ordinary share capital, preference shares, debentures, long-term loans, bonds. My weighting is my target capital structure. It's either given, well, I have to calculate it, and the way I'll calculate it is by using the current capital structure, using market values. Now, for each line item, for ordinary share capital, my market rate, I have 3 approaches. These are the 3 approaches. That's how I calculate. That's the formula, and these are the variables. For market value for ordinary share capital, there's 2 approaches. This is the formula. This is the variables. Then for preference shares and debts, I know one is given, one is not given. Whichever one is not given, I need to calculate it. The way I go through it is by asking myself, is it redeemable, non-redeemable? What makes something redeemable? What makes something non-redeemable? If it's non-redeemable, I use a perpetuity formula. If it is redeemable, I use a financial calculator, or I use a cash flow table. Remember, you can always use a cash flow table, but you can't always use a financial calculator. You can only use the financial calculator if the payments are the same. So for example, if all of these payments are the same, then I can use the financial calculator. In this case, I can't use a financial calculator because all the payments are not the same. Okay. So high level overview, that's my summary. Your summary will be different because not all our brains work in the same way, but we'll still get to the same result. So that is fine. However you want to, but basically you must be able to talk me through it. And I don't expect you to do it like that. But I just at least want to see that you are trying and that you are working on your thinking approach and you are working on making sure that when you tackle one question, you're effectively covering the entire topic. Don't just focus on that one actual required. Okay, that's all from my side. Sorry, one more thing from my side. We have now covered two WAC questions. We're going to have three. So what's the three? It's this one I'm going to put up. There's free class I'm also going to put up, but you should have watched it already if you are watching. But it is available to watch on YouTube, but I'm going to put it onto the platform. And then number three, the one I recorded today, the 2020 paper. So those are the three. If you do go through the three, which you don't have to, but at least two of them go through, you then want to sit back after you went through this kind of thinking like I just showed you now. You want to then say, okay, let me compare this one to the other one. What were the similarities? What were the differences? How did they ask if they required? And if you look at 2020, the required is exactly the same as this required. Exactly. They probably just copy and paste requires, change the date. So that's how exact it is. Maybe with a few grammar changes and to give you value for money and make certain stuff bold and certain stuff not bold. So that's the differences. Okay, so the similarities, otherwise exactly the same. Okay, and so that now the next thing, how is the scenario presented? You will see some scenarios are fairly similar, some is quite different. Okay, and then once you compare that, now actually based on the scenario, actually to answer the question was how did I have to think? Did I have to think differently? Was it the same type of information given? Did I have to use the same formulas method? Was it different methods? And if the methods were the same, well, to get dividends, you have to get dividends in the same manner or in a different manner, and things like that. So if you think or if you understand, if you comprehend the level I want you to review your work, you'll understand there's no chance of you getting through 10 question papers. But the quality of your 2 to 3 question papers is far superior to someone running through 10 question papers. And for me, that is the difference between what's going to make someone pass and what's not going to make someone pass. What's going to make someone get very high marks and what's not going to get high marks. So depending on which level you want to get to, if you are focusing on pass versus not pass, you follow this approach. If you're someone that want to get a distinction versus no distinction, you also follow the same approach. That's what's going to get you through, as opposed to running through tens of questions. If you run through tens of questions on this level, there's no doubt you're going to succeed. But if you can't do 10 question papers and do this approach, rather do this approach where you cover 2 to 3, which is going to be far more superior. Because by doing this 2 to 3 on this level of quality, it's going to be on another level. You effectively covering 20 question papers because you're constantly reviewing, constantly comparing, constantly telling yourself how things can be calculated, what is the formula, what would you need. So you're effectively covering it. Okay, so just keep that in mind. It's not easy, but remember, you joined the CTA. This is not supposed to be an easy road. It's not about things being easy. It is about you growing. If you watch that video I shared yesterday in the group. So for those of you who are in the group, I shared a video by Angela Duckworth, or some, I can't pronounce her surname. She wrote a book called Grit. So she had a TED talk on it, so like I think it's about 7 minutes, where she explained what grit is. It's about passion and perseverance, and what does that actually mean? It's not about not failing. It is not about not struggling, but it's actually keep on going and like just really working hard and persevering, doing the hard things now so that you can sip on your cocktails and mocktails in the future. Okay. But anyway, that's all from me. Do you have any final questions before we call it a night? If there's no questions, you can leave, and I'll just stop. I'll just pause and stop everything. Okay, anyway, guys, nothing. Cool. So no questions.